Jane and I at Nowen and Associates. We uh, we are a financial advisor, wealth management firm located in Homewood, and Jordan is our senior, and he has helped a lot of medical students at Sanford because that's where we went to school, and helped them specifically turn their student loans into an asset. So he's going to be running the presentation today. So if you're able to see his screen, he's going to share that with you. But Jordan, I'm going to leave it in your hands.
Awesome. Happy to be with you guys today. I'm gonna share my screen here in a second. Can am I able to do that? Okay.
Yeah, let me,
Yeah, go ahead and make me the host real quick, Zane.
yeah, okay. Just did it now.
Got it.
Quick
Got it.
question. Is it
Awesome.
okay for us to record or will the recording be sent to us?
Yeah, I'm recording right now and I'll just I'll figure out a way to send it to you guys as well.
Okay, thank you.
Yeah, absolutely.
And Jordan, by the
All right,
way,
awesome.
more people might be joining.
All right, go ahead. That's fine.
More people might be joining, so just keep a lookout since you're the host. I think maybe you're the one who has to admit them if they do come in.
Yeah, good call. All right, I'll watch for it. All right. Well, thanks so much, guys, for having me. I'm sorry I can't individually address each and every one of you, but I will speak collectively, and we'll spend maybe 15 minutes, maybe 20 minutes at the very most, going through a little presentation that I put together. This is a real life case study. I've been in the business for 10 years. I've worked with pharmacy school students, chiropractic college students, law school students, people that have come out of school, obviously medical schools, and are coming out either with student loan debt or other types of debt that we're looking to take their new income that they have trained and earned an education for, and how we could try to build an asset and simultaneously pay down their student loans or their debt. And so that's really what we're going to talk about today. And at the end of my little spiel, I'm going to spend really as much time as you'd like to answer, probably 5-10 minutes to answer some questions. And then just to kind of bring the future to the present, the goal at the end would be, obviously this is catered to a specific situation of a client, a real life client of mine from, I believe it was 2018, so 6 years ago. So if you want to look and actually investigate more about your specific situation and how you could utilize this, then my recommendation would just be to turn it right back to the capable hands of these young gentlemen here, and work with them and come into the office here in Homewood or hop on a Zoom call if you're not local, and basically take exactly what I'm about to show you and turn it around and show your numbers, your figures, trying to make this strategy customized to you. So that's the future of the present. And I think I'm not seeing anybody else joining, and I'll definitely bring them in if I do, though. Okay. Let's see here. Make sure I have it up. Okay. Yeah, we're good to go. All right. Let me go ahead and share the screen, and I'm going to walk through this presentation here over like I said, the coming, 20 minutes or so. Let's get this going here. Okay. So let me know if we're all good. We good, Zane? Everything looking good on your end?
Yeah, everything looks good on my end. Yep.
Okay, we got full screen. Lovely.
Yes.
I'm working with about 3 different screens up here, so sometimes I never know which ones are up, but I think we're good now. All right, so this was a specific situation in 2018. This is a pharmacy school student who had just come out of school, and we were dealing with a couple $100,000 of student loans, and she was making good money. She, I think, was making just over 6 figures right out of school, and just looking to try to figure out, hey, what's the best way to try to tackle this seemingly overwhelming debt? And of course, there's many ways, many different schools of thought to try to do that, where you can obviously just take X amount, 30-40% of every single paycheck that's coming in and just redirect it every month towards your student loans. You could wait, accumulate that same amount over the course of a year, and then put it in a side fund, and then try to just accelerate the debt by paying off big chunks of it. There's advantages to that I could go into at some point as well. But there's a lot of ways to skin this cat, basically, is the point. And really, you know, our strategy was, hey, why don't we try to get creative? The goal is to try to take what is existing as a liability and turn it into what will be an asset. Now, it's not going to happen overnight. There's no magic formula for this to just be, you know, all of a sudden gone and you to have $1 million in the bank. But if you can do something with consistency and something like this strategy with persistent aggression and persistent focus with a strategy, then all of a sudden 5, 10 years, 15 years down the road, you'll look up and have not only paid off the student loans, but also have created a really valuable asset of cash that could be advantageous for things that you're going to spend money on in the future, which are obviously cars and, you know, buying an investment property or buying a house or a vacation property or anything that's just going to otherwise, require cash. That's really what we want to focus on with this strategy. So let me just jump right in here. And we started in this specific example. I use this specific software to kind of show that we're trying to pay down $200,000 of student loans. And this particular client said, I'm paying, you know, I think it was $500 a month was her minimum payment. And we said, okay, well, if you're going to pay $500 a month, you have an extra, in this case, $1,500 a month that we could apply towards that debt that we wanted to try to, you know, throw towards that. And keep in mind, everybody, this is one specific example. These numbers could be way off, way too big, way too small. It's really just kind of encapsulating the concept and what we're trying to do. So over the course of time, what I showed her was, hey, this is in 2018. If we fast forward by accelerating this payoff in addition to our minimum payment at $1,500 a month or $18,000 a year, we could have this thing paid off by March of 2027. So that's at this point about 3 years from now. So we're well on our way, if not ahead of pace, to do that with this specific client. But that was kind of our goal line, because I think it's really helpful to see, hey, this feels like this is going to take 25, maybe 30 years or more in order to pay off these student loans. They're going to be with me forever, like a mortgage. Well, in this case, we proved that even if we just simply added additional cash towards paying this off, just to accelerate it a little bit faster, that we could have it all paid off within 9 years. So much faster, not only from the regular traditional 25-year payoff, but even more so to a 10-year payoff, and even faster than that. So this is a calculator that I want to go into, basically to kind of visually represent the different ways in which we could use extra cash to pay off student loans. Okay, there's nothing more. I'm gonna compare a couple of different examples. We're gonna look at just cash in a shoebox, aka a non-interest bearing account. We're gonna show looking at money in a savings account, aka, hey, it's earning a little bit of money. And then we're gonna look at, ultimately, what if we funded a uniquely designed life insurance policy that was designed to accumulate cash and build up cash. It's not built for death benefit, it's built for cash. And we're going to use that almost as if it's our own bank to go and pay off this student loan, and then see what the impact of that would be over a 30 or 40-year period. So that's really what this math is going to be about, and this exercise is going to be about, is just proving, hey, we already know that it's very simple. If you overpay on a payment towards your student loan, it's going to be resolved in a quicker manner. That's as basic as it gets. Nobody would argue with that. All we're trying to do is say, if we acknowledge that that is the case, let's look one step further and say, what is the most effective way in which we can do that to accelerate this specific strategy? And that's what we're going to look at here today. So if we started in this case with $1,500 a month, which is what we talked about before, that's our extra payment that we're going to just set aside into, in this case, a shoebox, just to build a baseline. And we're looking at a 40-year window, $18,000 a year, and we're not earning anything on it because it's a non-interest bearing account. And that's going to accumulate to, and I'm keeping track up here in my my legal pad, at 374. And so if we went one step further, what's going to be relevant is, well, obviously I'm not going to save that much money into a literal shoebox or a safe or anywhere that's not earning interest. I'm going to go at least put it somewhere where I can earn at least some interest, which would be like a money market account or an interest bearing account, like a savings account. Ironically enough, I did this in 2018. And at that point, it was hard to convince the client that 2% was even possible. And now we're on the other end of the spectrum where I'm having to convince people that 2% is actually a pretty average, decent return in an interest-bearing account, because people are thinking, oh, I can get 5% at a money market now. So just goes to show you the variability of the interest rate environment is going to occur, and it's going to ebb and flow. But over a 40-year window, we can comfortably say, if we could, safely set some money in somewhere and earn 2%, it's going to be yielding us a good value. So we're paying that $1,500 a month, and I drop it down after about 10 years to $600 a month. I'll explain why later, but just kind of go with me on the exercise here. So in the second example of a savings account, we're earning 2%. We're paying taxes. Taxes right here in the red. So you can see it's actually costing us money in taxes. Yes, savings account actually make money, and they do have taxation with them. This is something that's not familiar to a lot of people if you've been saving money into a savings account from anywhere from about 2009 to 2022. But now the interest rate environment has changed. It gets us to $523,000. So what we've accomplished is simply, okay, obviously this is a good place to save money. This is a place that we'd want to just try to settle, set some money aside. And that way it's going to give us a little bit more return than just a non-interest bearing account. Well, we're not going to save this amount of money over this period of time and not withdraw or use the money. So let's look at the third example. Well, we're going to actually take this money out at $18,000 a year. So we put 18 in, and then at the end of the year, we take it back out and we go and apply it towards our student loan, right? We just build it up over the course of the year. We say, I got an extra $18,000. I'm going to apply it towards my $200,000 student loan, and then just rinse and repeat until that thing is gone, as we said previously, which would take about 8 years. And so we would do that exact same duplicate. The problem here, this is the first concept that's really important that these guys understand, probably more than any concept here. We have an opportunity cost. This is probably something you may have heard in economics in high school or even in college and probably forgot about. Maybe if you're a student of behavioral economics, you've heard about this, but opportunity cost is quite simply, what does it cost to make a decision to do one thing over another? So in this case, we are making the decision to remove our capital to go and put it towards our student loan balance to the tune of $18,000 a year until it is gone. Well, that is actually costing us money, because every year when that money is removed from this account, that means that there's less and less money that can now earn over the long haul, right? So that opportunity cost is not just a concept, it carries a quantitative value, and that amount of money over the 40-year window that we're looking at accumulates up to $90,000. So if you look at, it took me an extra $144,000 to go and accelerate paying off my student loan so that I could have it done in 9 years versus 25 years. But in reality, if you really factor it in because of what it was earning in the savings account, it actually cost me an additional $90,000 beyond the 144. So it actually cost me $234,000 to just pay off this student loan that's so burdensome over this window of time. And I was trying to be, in this case, this particular instance, I'm trying to do the right thing and accelerate this and get it done. and it ends up costing me an additional $90,000 that I never would have otherwise realized. Now, this is the problem with and you can see over the course of the 40 years, our 523,000 becomes 289,000. So that can be a problem as well. We want to try to magnify what this impact is going to be over the long haul. And so then we would look at, perhaps, what if I instead did a cash deposit and then use the money, but then filled my bucket back up? So I basically did the same thing, saved the $1,500 a month into a savings account, earned the money in the savings account, took the money out of the savings account and went and used it. But the one caveat was, I said, okay, clearly this money has a cost. I want to replenish it back into my savings account with income that I'm making at my job. Okay, so that I can make sure that I'm not losing the value of the money that's earning in the savings account. And so just by doing that one thing and accounting for the fact that that dollar has a cost, so let's just say it was going to cost you 5% to go and borrow the same dollar to go and pay off the student loan. Like if you were going to refinance it, then you would say, I'm going to pay it back to myself and add 5% because that's what the money costs. So I'm going to do that over the course of the time that I'm using to pay off the student loan. And then once I'm done paying off the student loan, I'm just going to keep paying that $1,500 back to myself and fill it back up. So what did that impact have on my end result? Well, it significantly decreased the amount of opportunity cost that I have now in the deal. What was costing me $90,000 is now costing me $1,900. So this is a significant development just by simply paying ourselves back and being what we would call being an honest banker in the use of this strategy. We help to mitigate our opportunity costs significantly. And if you look at the impact of this over a 40-year window, with my sticky note up here, we ended up having $531,000 of cash on hand as opposed to $523,000, which is what it would have accumulated to if we had never taken the money out at all. So we ended up using the money, and somehow through this concept of what's called economic value added, or EVA, another nerdy economic term that you may have probably forgotten years ago, that's just treating the dollar as if it has a cost. So we learned a couple lessons, just to recap. One, opportunity cost is what something costs if you trade off and make a decision to do one thing with the dollar. So we've accounted for that by replenishing it back. And the concept too is we're replenishing it back to ourselves as what the market value of the dollar is costing. So if it costs you 5% to go to the bank and get money, again, this is 2018. So now it's probably 9 or 8, right? Well, that's what money costs in the open market. So we have to put the money back into our bucket if we're going to be our own bank, which this strategy is all about becoming your own bank and becoming owners of the bank. We want to replenish our money at cost like it would be in the open market, because that's the only way that it can hold its value. So those are the two nerdy little economics concepts. We'll just push those to the side, but those are important things to understand as to why this concept works. So we didn't change our cash flow. We didn't do anything different. All we did was take the money out, set it aside, pay off the student loan that year, or make a dump towards the student loan. And then whenever we had that thing totally gone, we just kept that $1,500 a month rolling back to ourselves at 5% and ended up with more money than if we would have never taken a single dollar out. Now, I'll pause and note that this is all happening right now still within just a run-of-the-mill savings account at the bank. Okay, so there's nothing fantastical. You guys could take exactly what I've set up to this point and go and execute this with ease by just doing this out of your savings account, doing this out of a money market account. this concept works. Those principles that I mentioned work. Where Jordan and Zane, what they do a good job of is they emphasize using whole life insurance that is properly structured with a mutual company and overfunded and structured for cash specifically, not death benefit, towards, that's the goal. That is the use of that policy to basically replicate the same model. So let's look at what happens if we simply substitute that life insurance policy that I just mentioned and overlay that exact same thing into what the example we just looked at up to this point. If we do that, we end up with $1,047,000 over the course of a 40-year window, compared to $531,000, which was our second best strategy. And to be honest, most people are going to do this option, which is where they just take the cash, pay off the student loans, and then rest and say, hey, it's gone. I can breathe easy because the loans are gone and I'm done. Well, the impact of that is significant because we have opportunity cost. But once we utilize EVA and start replenishing our cost, it helps significantly. And then once we utilize a life insurance policy, the way that these guys will teach you how to structure it, it ends up significantly bolsters our end result. So let me walk you through exactly what happened here. So we have a policy that is guaranteed to grow. It's never going to go backwards in value. It is also, as you'll know, this column went to zero. It's a tax-free instrument. So whole life insurance is a tax-free instrument. It grows tax-free. You can use it tax-free. When you pass away, the death benefit that is also included in this, it's not the emphasis, but it's also included in this, that also goes to your heirs tax-free. So those are two things right there. The third thing is, when we remove, quote unquote, when we remove the money from a policy, we do so by borrowing against the policy, almost like leveraging, kind of like an equity line of credit. A home equity line of credit, you can borrow against the value of your home, and your home is not going to change in its value at all. It's going to actually stay the same and probably rise, because that's what the market is and that's how the market is impacting your home. With a life insurance policy, it's the exact same way. It's going to continue to earn, as you see here, every day, week, month, year, and grow over that window of time, even if we are borrowing the money and going and using it to, in this case, pay off student loans. So we end up maximizing this huge asset that we end up with $1 million in over a 40-year window by doing nothing other than just simply getting creative about how to pay off a couple $100,000 of student loans in your 20s and 30s. And the strategy is sound. The strategy requires education. So I'm not going to continue to belabor all the minutia, and these guys have a lot of things that they can position, they can position to you that are watching and interested and want to learn, that are incredible resources to learn about. Okay, I see the math. This is interesting. That's really all that we're doing here today. Is we're not going to spend 2-3 hours to deeply educate every single specific point of this. But to conclude, what we're trying to surmise here was, we use the life insurance policy to, instead of just getting rid of debt in 20 years or 10 years, we've gotten rid of debt in the same time and turned around and built this ever compounding, tax-free, safe, liquid asset. Okay, money you have access to, and on day one, money you have access to in year 20, and once you pay off that student loan, it now becomes something you're going to use for something else, right? It's going to be, we're going to go buy a house now that we're done with this $500 or $1,000 or $2,000 a month student loan payment. That means we can go get a mortgage, and this is great. Well, that's going to also require cash. So we continue to expand our policy in this case as, like I said before, it's our bank. And that bank just gets bigger and bigger, and we borrow against it to go use for all of these things and continue to earn in it for forever and ever. So, as I mentioned before, it's a tax-free bucket that we can use for all the things we're going to use for the rest of our life. Additionally, in the long term, it's a beautiful tool that we can use as a tax-free retirement. Let's say we have, you get to where you have $1 million or $2 million in a policy, you can turn that money on as an income stream, and that money is not taxable. Okay, so it can basically provide retirement income if you're done working, and you'd have to work with these young guys on how all that would work and how to position it alongside your additional retirement. But if you do it right, there's a way where you can create this policy to function as a tax-free retirement for that window of your life. And again, this is not an overnight thing. This is something that's going to happen. It takes some time. It takes some diligence. But I've been able to do it with some clients for about 10 years now. And it's really exciting because I'm now walking with them through this journey and seeing the light at the end of the tunnel and finishing these student loans off. And now we are not waiting for this, for years and years and years, decades even, to start getting financially independent. One of the biggest pitfalls that I've seen with attorneys or doctors or people who have to go to additional schooling to become the best of their craft is that they wait way too long to get in the game when it comes to actually creating wealth and growing wealth. And I think that is one of the, if not the most important component of all that I mentioned today, is instead of waiting until everything is, paid off and you have, the kids are gone and you've got no other additional issues or no other additional requirements for your money, and then starting to invest or starting to try to grow wealth, it's about starting early and letting compounding interest do the heavy lifting. That is the number one suggestion and advice that I would give to anybody who's a young person out there, 20s, 30s, because as we all know, we can life will just continue to throw stuff at us. And, pretty soon you'll wake up and you'll be 50, 60, 70, and you have no plan in place. So this is a way for you to work with these other guys, Zane and Jordan, and to have them build you a strategy, how to show them exactly what I just showed you, right? But with your numbers and kind of customize a plan and say, hey, if we do X, Y, Z, because we're working with guarantees, we're working with the known and not the hopes, we're going to be in a position where we know at the end of the day, this is how much money you're going to have at this point in your life. And I think that's something that you can't just go to the average wealth advisor down the street and glean from them, because in this case, we're really significantly working off of what is known and not what we're hoping for. So, guys, that's really my main thing. I just wanted to walk through some of those conclusions and wrap it up.
Awesome. Thank you. Thank you so much, Jordan. Before we go, I wanted to go ahead and give you guys a link to Jordan's podcast. Jordan and a couple of the senior guys at our office created this fantastic podcast. If you guys are big podcast listeners, you can learn more about this and just hear it as you're driving or going about your day. But we're going to go ahead and follow up with you guys. We would love to sit down and see your numbers to see exactly what you got going on, whether it's student loans or car loans. But yeah, looking forward to talking to you guys and helping y'all. So thank you so much for your time. You guys have a blessed day.
Thank you, Jordan.
Thank you. You as well.
Thank you, guys.
Thank you.
Talk to y'all soon.